Let me now introduce our next session, Transformation of Global Capital Markets Post-Financial Crisis. Our distinguished speaker today, Doug Peterson, will be interviewed by Giancarlo Bruno, and will discuss how the capital markets have changed in Europe and in the US over the last couple of years following the financial crisis. Giancarlo Bruno, also alumni Bocconi, very active member in New York, part of our New York steering committee, and a resident of the New York City. He serves as senior director at the World Economic Forum. He has had the financial service industry group and is a member of the management committee. Giancarlo will interview Doug Peterson, so Giancarlo, please join me here. Thank you.
Thanks, Maria Francesca. Obviously delighted to be here. I will moderate this conversation with Doug Peterson. Let me say I'm absolutely delighted and grateful that Doug accepted our invitation. Doug is the president and CEO of McGraw Financial. For those of you that are not familiar, it's a $23 billion market cap company, and one of its most known businesses is Standard & Poor's, the world-famous rating agency. Doug spent several years at Citigroup, and I really thought when I came up with the idea of asking him to join us today, I thought that what would be very interesting for this audience is to get his very extensive perspectives on capital markets from a very international standpoint for obvious reasons. I just wanted to say a couple of very quick words on the subject of the conversation today. Doug will let us know his perspectives on the future of capital markets. There is a lot going on, obviously, internationally. The regulatory context is very complicated, and it has been driving a significant change in business models of financial institutions. There is technology disruption. There is protectionism, which is an interesting sort of political angle that I will ask Doug to elaborate on later on. But the only thought that I want to leave you with before leaving the podium to Doug is, why is this important? Not all of us work in for financial institutions or are directly involved with capital markets. So why is this subject important, and why, with my friends on the steering committee that organized the conference, why did we think that it was an interesting subject to approach? Because capital markets, because financial markets are at the core of economic growth. If they don't function, economic growth is impacted. Financial institutions and financial markets are at the fuel of productivity and economic growth. And we want to understand with Doug what is the current situation, what we'll be looking forward to, and how financial markets will continue to play their role at the core of economic growth, job creation, that all countries in Europe, but also in America, desperately continue to need. So with that, I will ask Doug to please come to the podium. Thank you. Thank you. Thanks, Doug.
Thank you, Giancarlo, and good morning. Welcome to New York for those of you that are not from New York. I'm going to share a few minutes with you this morning talking about the evolution of capital markets since the financial crisis and many of the themes, very importantly, looking forward, looking to the future. As Giancarlo mentioned, McGraw Financial has a different series of businesses that are all involved in capital markets, commodity markets, bringing information and data and analytics and ratings to the businesses. As you look at 2014, we still have an environment globally with a lot of uncertainty around capital markets. There's still a market where you have regulatory interest, you have incredibly low interest rates, you have low volatility, but you don't have growth. You still see an economy that is not growing at the capacity that it should be. So thinking about some of the trends going forward, If you look over the next 5 to 10 years and you think about the shape of global financial markets, I'm going to talk for a very few minutes and then we'll explore these more in depth in the Q&A about 3 key themes: policy and regulatory activism. This is an environment where we're seeing the policy framework of regulations as well as the role of central banks around the globe playing a very critical part of the economy, and many times much more so than the fiscal and the structural aspect of governments. Second, we're going to talk about deleveraging and disintermediation. What does it mean when the traditional financial banking market is shifting into new types of financial activity that might not even be regulated? So there's so much regulation squeezing the traditional banking system that you see the escape valve moving into non-regulated businesses, or what's called shadow banking. And third, I'll talk a little bit about the impact of globalization, but we could spend the entire day here talking about globalization, so this will just be a few minutes. First, this is a picture, this is a simplified picture of Dodd-Frank. Dodd-Frank is a law which was passed in 2010 by the U.S. Congress to attack and to remedy and to find root causes of some of the problems of the financial crisis. Dodd-Frank is 2,400 pages. If you go back in history, in 1913, when the Federal Reserve was formed, the Federal Reserve Act was 31 pages. The famous Glass-Steagall that separated investment banking and underwriting from commercial banking and deposit banking, that was in 1933. It was 37 pages. And now we have Dodd-Frank, which is 2,400 pages. And the famous Volcker Rule, which originally was one sentence by Paul Volcker, is now 900 pages. And when it was issued, there were 17,000 comment letters. In order for any of the rules to be put in place from Dodd-Frank, of which there are 243, each of them have multiple regulatory agencies that they need to be reviewed by. So as you see, the SEC, the CFTC, the Federal Reserve, they all have new mandates added to what they were already doing. You have a new organization, the CFPB, the OFR. These were new organizations added to the regulatory environment in the United States. The rulemaking is behind pace. It's something that the regulators themselves and the Congress know that it's behind the pace that it should be. And it creates uncertainty and it creates a lot of risk to the environment because there's so much uncertainty about what is going to happen with very critical aspects of the banking and financial markets in the U.S. Another part of the government that has played a critical role since the financial market are central banks. Central banks are my heroes. Central banks in the last 7 or 8 years have been the people that stepped up to use policy tools that they had to ensure that the recession didn't turn into a depression, and to stimulate growth and to stimulate an economy that would have the ability to create jobs and not go over the edge and not go over the cliff. But how did they do it? They did it by massively expanding their balance sheets. This chart here shows you the growth in the balance sheet of different major central banks around the globe. As you can see, the sharp increase in the United States, this is a quantitative easing, purchase of financial assets from the markets. Today in the U.S., it stands at $4 trillion. And at the beginning of the financial crisis, the U.S. had a balance sheet that was somewhere below $400 billion. Some believe it was even lower than that if you net out the assets. So this balance sheet has expanded dramatically, and we're in this experimental phase. What's going to happen as economies start growing again? Will we see how are these balance sheets going to be shrunk? How are you going to take a balance sheet in the UK, in the US, in Japan, and allow them to shrink? There are a lot of discussions about that, about natural ways to see the assets mature. They can roll off, selling the assets into the markets if the economy is overheating. But this is something that you've got to watch. We have a zero interest rate environment, or the ZIRP, Z-I-R-P, which was invented in Japan 15 years ago, and now we have the NIRP, the negative interest rate environment in Europe. This is an area that you've got to keep a watch on if you are in the financial markets. Second big trend is deleveraging and disintermediation of the financial markets. In the past, you had the intermediation of traditional deposit taking and lending in the banking environment. There's a transformation of maturities in that type of a model, and you have a risk transfer. Over the years, you've seen more and more different types of risk transfers. But now we're seeing something different. The banks are dramatically deleveraging their balance sheets. On the left-hand side of this chart, without paying attention to the numbers, just look at what that means for the deleveraging of the European banks in red and the American banks in blue. They have been shrinking their balance sheets, or they've been increasing capital, which means that their lending capacity has been shrinking from what it had been or what it theoretically had been. Well, where's that being made up by? So if the economy continues to look for financing, it's going to the middle and to the right. It's going to the U.S. structured finance issuance, which you can see has dramatically been growing the last few years. And that's in traditional structured finance. It's not in what was the root of the crisis. It's not in residential mortgage securities. It's in traditional asset-based financing, which has done very well throughout the crisis in its entire period, and other types of commercial and CLOs, which are loan obligations. You also see that the syndicated loan market is heating up. And who buys those syndicated loans and who buys those securities? Asset managers, pension funds, insurance companies. But you see here, this is the growth in the last 10 years, in that 10-year period from 2002 to 2012, of the assets of non-bank financial intermediaries. Non-bank means that it's organizations that do not take deposits. And if you ask different parts of the world, what do you mean by shadow banking? In China, they define shadow banking as any organization that's not taking deposits. In other parts of the world, they might say shadow banking or non-regulated financial entities. No matter how you define it, this growth is showing a dramatic increase in the lending capacity and the lending volumes of non-bank institutions. And it grew almost 3 times from 2002 to 2012 and has grown to be almost 120% of the economy this is of the U.S. Now, I recently met with a CFO of a major global conglomerate that is an industrial company. That industrial CFO told me, I'm becoming a bank. He said, I used to run my organization and worry about capital investment, about my shareholders, about taxes, about how I was going to raise capital. But he said, now I also have to worry about how I'm going to lend money, because the banks aren't lending money. And because you've got this shadow banking system, I'm also becoming a bank. My clients are asking me for credit. So you're seeing a very big shift in the sources of credit in the markets. The third broad theme, and I'm sure you're talking about this all day, is globalization. And this is a very simple chart that comes from Deutsche Asset Management and the Financial Intelligence Unit. This is showing that by 2030, so about 15 years from now, the largest debt markets in the world are no longer going to include France, and Japan's going to slip to number 3. So the U.S., China, and Japan will have the 3 largest debt markets in the world. The largest equity markets will be the United States, China, and India. And you think about, why is that? India and China have populations of 1.2 and 1.4 billion today. The U.S. has a population of 315 million. Europe is 500 million, more or less. And so you're looking at large economies that have growing populations, younger populations, especially in India, that are consuming, they're traveling, they're buying, they're saving for college, for retirement, and that's creating the conditions to have much larger capital markets. As those economies shift to domestic consumption, you'll see much larger markets. Now, what about people's capacity to be ready for globalization? What are those barriers to globalization? In a survey that was also done by Deutsche Asset Management and Financial Intelligence Unit, they asked people, are you ready for globalization of the capital markets? About a third of the people in different categories said, no, we're not. We're not ready. We don't know how to deal with global financial markets. They don't know about the rule of law. They're concerned about stricter regulations. They're concerned about how are they going to gain knowledge. So as we lead up to the Q&A session, just a few final thoughts. The financial markets are large. They are the fuel that provide the oil and the gasoline for the real economy. They are a source of creating finance for jobs. They're the source of how we look at the banking system and the intermediation system around the globe. But they're going through a lot of change. We see the role of central banks. We see the role of corporations. Those are changing. So the message I want to leave you right now, before we move into the Q&A session, is that you cannot be complacent. If you're a banker, an investment banker, if you're a corporate treasurer, if you're an entrepreneur, the markets have changed. Even though you look today, there's an index called the VIX. The VIX is traded on the CME in Chicago, and it's a level of volatility. It's an implied volatility measure. It is as low as it's been in the last 20 years. Interest rates are zero. We're at the ZIRP. We're at a zero-bound interest rate environment. And you would think at a zero interest rate environment and low volatility that things should be okay. But there's a lot of risk out there. Don't be complacent. Be prepared for risk. Ensure that you're always watching what's happening in the markets and keep your eye on what's going to happen with central banks. Thank you very much, and I look forward to the Q&A session.
So while I have a few questions of my own, and I wish that this conversation could go on for a few hours, obviously I want to make sure that if from the audience we have questions, you just raise your hands and we'll bring them up. So maybe I'll abuse the privilege of being sitting here, and I will ask the first question. Doug, thanks for the presentation. You have given quite a global overview because Bocconi is a leading European academic institution, and many of the alumni come from that region. I want to ask you a question that is specifically on Europe. Unlike the US, in Europe, traditionally, everyone knows financing to entrepreneurs has come from banks. You have made a clear reference to the fact that banks are either have been requested or have decided to deleverage. So in that sense, they have been, to be very clear, lending less. So there is a clear challenge because financial markets and capital markets in Europe are not as developed as in the US. So how do you square the circle here, and how important is this to explain the low productivity and low growth in Europe? And more importantly, what can be done? What would you advise policymakers to do in order to address the fact that banks have been either deciding or being able to lend less, and there is not much else, so to say, for risk takers to do what they need to do, which is to create GDP and jobs. And in particular, if I may, that those that get squeezed out are the SMEs that are famously at the core of job creation in Europe.
Well, a few comments. First of all, as you point out, SMEs truly are the main source of job growth. And one of our employees recently did some work before she joined our company looking at where do jobs truly get created, and they do get created at SMEs. It's all the way from people starting restaurants and dry cleaners to high-tech startup firms. That's the real engine of growth in all economies around the globe. The European financial markets, as opposed to the US financial markets, there's a couple of key differences. One is for corporate financing, the U.S. has about an 75 to 80% of the corporate financing is provided through the capital markets, 20 plus 25% through banks. And in Europe, it's the other way around. It's about 25% from capital markets and 75% from banks. So that right there is a structural difference that now as banks deleverage doesn't give you that escape valve for corporations to go to the capital markets to raise funds. But it is happening. And it's happening with in particular with the organizations that are at the cusp of investment grade and non-investment grade that are going to the markets. They're raising bonds. So the financing in Europe for bonds has increased in the last 2 years at a 30+% growth rate each year. So you are seeing European corporates, but that also leaves the SMEs out. They don't have the capacity. There's another very big difference between Europe and the US, and this one might even be more significant. You saw on my chart, one of the charts showed the increase in securitization as a way that you have to finance bank balance sheets and corporate balance sheets in the U.S. There are different asset classes of those types of securitizations. And in Europe, they're all dead. There's no securitization going on in Europe except for covered bonds for the banking sector. Besides covered bonds, the amount of securitization in Europe is anemic. And in fact, it's been cited by Mario Draghi as one of the problems that the ECB faces if they do want to undertake aggressive quantitative easing. Mario Draghi would rather undertake quantitative easing if he did so, according to his statements, using private sector assets, not public sector assets. There's also potentially structural reasons for that. And because there's so few structured finance assets, he would completely dominate the market if the ECB started going out to buy structured finance markets. Third topic, and this is getting into a much broader bank discussion, the U.S. undertook bank reform more aggressively and earlier than they did in Europe. So the stress test, the recapitalization of the banks took place earlier. Right now in Europe, you have the first round of asset quality reviews, which is taking place. There's capital reviews, and then there's discussions about a European-wide deposit insurance corporation, which will stabilize the banks and also de-link the risk of banks from the sovereigns. So a lot to talk about, but I'd say that you've got the structure of the markets. You have in particular the structured finance products and structured finance markets, which have not revived in Europe. And then you've got the overall health of the banking system, which is now going through a very deep review.
Thanks, Doug. And again, don't be shy. If anyone has questions, please.
By the way, I used to live in Costa Rica, but I'll go for Italy today.
Yes, please. There is a gentleman in the second row.
Thank you. Hi, Giacomo Frizzarin, class leader of one of the MBA class. I've been working with large US companies that are based also in Italy. And one thing you mentioned is about the role they can have in the market as banks. We do have, like, and I'm working with HP before Cisco, they all have their internal financial structure to support the clients. And we are facing a lot of demands, increasing demands by the small and medium enterprises to give credit to them. So the question is how these large companies should, let me say, talk or work with the government to facilitate the process. Because in the middle, there are many regulations that put some hurdles to it. And I think they can put hurdles to some growth. These US companies or other large companies can bring to the SME sector in our country. Thank you.
Thank you. And the discussion about SME financing is one that's critical. And as I mentioned, and as the gentleman just mentioned, you have a lot of large corporations that are part of a value chain of production that are being asked to use their financial assets to support their value chain. And so the question is, what are they taking too much risk? How do they manage that risk? Let me take one step back first and talk about what's happened over the last 10 years. When the financial crisis hit in 2007, in particular in 2008 after Lehman, if you were running a large global corporation, you were worried about raising cash and capital from your bank and from the markets. And you managed over a period of time to cash. You focused on liquidity and cash, and you had as much as you could. You then shifted, because of the recession that was going on, into productivity. And you said, well, I'm going to manage to cash, but now, because there's a recession and slow growth, I need to be more productive. I need to look at my bottom line. I need to manage to my expense base. Depending on which economy you're in and how you've evolved, that's now moving to people investing for growth, continuing to diversify and manage to cash investments. But what you're talking about now is how can you use your balance sheet to support your supply chain, to support the economy generally. There's many ways to do it. First of all, one of the reasons that the securitization markets are so valuable in the U.S. is that's one of the ways that corporations are able to lay off the risk of taking SME and consumer credit for part of their balance sheet. So if you're AT&T and you have a huge, just imagine how many iPhones AT&T sells with contracts. And those contracts are basically credit. If you think for 1 second about AT&T's mobile phone strategy, they're running a bank in a sense, because they sell an iPhone to somebody and they know that they have a contract over the next 5 years. They basically had to lay out the full cost of that iPhone to Apple, and now they're not going to get paid for 2 years. One of the beauties of the very liquid securitization markets is that somebody like an AT&T can securitize those receivables in the market and take them off their balance sheet, and in many cases even transfer the risk, because there's people willing to take the risk. So that's one of the ways that you can transfer risk and shrink your balance sheet. There are also other ways. There are around the globe Ex-Im banks. The U.S. has an Ex-Im bank, which is actually under attack right now. There are people in the U.S. government saying that the Ex-Im bank should not exist, that it's a subsidy system to people that don't need the subsidies. But one of the main uses of Ex-Im bank is for large exporters to fund their entire supply chain with financing that allows them to also help their SMEs. There are other types of programs for SMEs around the globe and around the U.S., but let me just stop there with securitization and Ex-Im bank type supply chain financing tools.
Yes, please.
Thank you for an excellent presentation. Jean Ergos, Macro Strategy, GC Group Capital, also teach at NYU. You made an excellent point there about we shall not be complacent. It all looks good, we shall not be complacent. This reminds me, I was reading a book recently called Masters and Commanders about the Second World War, and the head of the Chief Imperial, head of the General Staff in Britain said in 1950 after D-Day, it looked all right, it was very close, let us never be complacent. I think it's a good warning. One question I have is this, related to capital markets. I spent a lot of time in them, and what I've been seeing recently, it seems to be a complacency, which is rampant, about high-yield debt. Mm-hmm. Now, high-yield debt spreads, I mean, you'd be absolutely amazed. You'd think some of these people, their mom wouldn't lend them money, but they're paying barely above what the top corporates are paying. There must be something wrong here. So do you see, in any way, without sort of transgressing any of your professional discretion, do you see a risk building here, and do you think that in fact there could be a problem, however efficient the capital markets are, in refinancing these companies as we go along? Because obviously, even without interest rates rising, it could well be a problem that if growth is low, as you rightly point out, because even though we have this great hullabaloo, growth is low, they may not meet their cash flow projections, whether interest rate is 3% or 6%. We could have a very big problem. Or how do you think that central banks should start reacting to this problem? Or do you think it's a problem which the market will have to sort out through massive restructurings as we go along?
Well, first of all, what the gentleman is talking about is that currently there is, because of such a low interest rate environment and there's so much liquidity, there's a lot of demand for assets and there's a lot of demand for yield. And what that's meant is that when Standard & Poor's in our organization rates bonds, we call those non-investment grade, that are below the BBB- level, those are going out with an assessment of their credit that is a higher risk credit, if you want to call it that. And as you go down lower and lower in the credit chain, what you're seeing right now is that the yields that are being demanded by the market are shrinking. They're getting lower and lower, and they're getting tighter and tighter for those lower quality assets. And same at the higher quality assets, those rates are also getting squeezed. So there's two components to the interest rates in the markets. First is the actual base rate. So what is the underlying rate? If it's in the US, you might use the 10-year Treasury yield. In Europe, it's a 10-year ECB yield. In Japan, it's the 10-year yen bonds. So you have some sort of a yield, some sort of a measure. And then the second is, what is the spread? So you've got the underlying yield and you've got the spread. The question is then, if you start getting back to a normalized high growth economy, lower unemployment, and let's use the US as an example, and interest rates start to increase, what will happen to that pool of assets which was financed at a very low level? I can't predict it, and I'm not going to predict it. But going back to my point about complacency, I think it's absolutely critical that financial institutions and investors are very aware of the kind of risk they take on. There's credit risk, there's interest rate risk, there's liquidity risk. In the financial crisis, there was a lot of all of those, and in particular, a lot of liquidity risk. But I think that this risk is one that we should be talking more about. We should definitely be having a dialogue about this decrease in spreads, this search for yield. Now, one of the interesting tools which has been taking place a lot right now in the markets is certain borrowers and certain lenders are financing with floating rates. So there's a much broader increase. And if you remember on one of my charts, I showed there was an increase in what was taking up some of the deleveraging disintermediation. One of the charts showed the securitization markets. The other showed the dramatic increase in leveraged finance and in leveraged finance and leveraged loans. Now, there might be credit risk in those, but those don't have nearly as much interest rate risk because they're financed with LIBOR or some sort of a floating rate. So I do see a lot of increase in demand for floating rate instruments. That's one of the escape valves on that. But your point is absolutely critical and one that nobody should forget, that they are taking interest rate risk when they make loans.
Thanks, Zach. I think we have time for one last question. Please.
Hi. Hello. Yes, Alfredo Baldini. My name is, I'm a Bocconi alumni, 1990, and now I work in Washington, D.C. on the IMF. I'm an economist. Of course, I'm speaking only for myself, and I'm very happy to be here in this reunion. Well, as a McGraw Hill, you are also the owner of Standard & Poor's, and we understand that there was a lot of criticism at the end of the eve of the global financial crisis about creating rating agencies because they were, well, maybe not sounding the alarm on CDOs, for example. And there's still some hot debate about this. So my question to you is, how Standard & Poor's and other credit rating agencies are taking care of those criticisms, and what is the governance inside the rating agency that makes us sure that asset-backed security, we don't have any more well, let's say global financial crisis like this, or at least that the rating agency are keeping themselves to stave off these dangers. Thanks.
Yeah, thank you. So the rating agencies were, leading up to the financial crisis, they've been around for a long time. In fact, Standard & Poor's was originally founded in 1860 by Henry Varnum Poor, that published a compendium of railroads and canals, which were the real driver of the growth of the U.S. economy. And so over time, the types of analysis that have been utilized by rating agencies have changed and changed and changed. So there's another evolution that took place after the financial crisis. What's very critical after the financial crisis is fundamentally the rating agencies were using models which were also consistently being used across the entire industry, unfortunately, and the regulators, which made fundamental assumptions about the correlation of housing markets across the economy. That you'd never see an entire market downturn in such a short period, or that the assets that were in the securitization would be sufficient to cover any sort of risk. Well, that was an assumption that was wrong. And it was wrong at the rating agencies, and it was wrong also by the investors. So since then, S&P has invested heavily in revisiting all its models, in rebuilding the criteria and methodology for many, many different asset classes, all the structured finance asset classes, and very importantly, looking at consistency and comparability globally for all types of financial instruments. As well, you didn't ask me about the sovereign side, but the sovereign is very important for S&P to look at sovereign ratings and understand all of the different elements. But two things critical. First of all, the rating agencies and S&P operate with very transparent criteria and methodology, and we're always open for dialogue and debate. And second of all, since the financial crisis, we have become regulated, and we have very good relationships with our regulators as they write rules to ensure that it's a very safe and sound, transparent, and thorough industry. So thank you for your question, and I appreciate having been invited today. And I will also be watching the game at noon.
Thanks, Doug.
Thank you.
Thank you.